Hey everybody, it's Kevin Clark. I'm the CEO and the co-founder of Plant Confidence Corporation, and I just want to say happy April 1st. We got the first quarter behind us, and we're going to do a very quick update today to let you know what happened with the previous quarter, what we're looking at for this quarter, and how to get the exact recommendations for the advice for your plan here. So quickly, Dow Jones for the quarter down 4.6, S&P down 4.9, and NASDAQ, the tech-heavy NASDAQ, was down 9% for the quarter. Yikes. However, we saw a little bright spot coming in with the last 2 weeks of March for the past couple weeks. The S&P was up and the NASDAQ was up 3%. The Dow was up 2.2%. So those numbers could have been a lot worse, but for the past couple of weeks, we've seen a technical bounce off of the lows. So whether that can sustain or not, we're going to see. Also in the first quarter, we saw the Fed, the federal government, raise interest rates. That's the money that they allow banks to borrow from them, which then they pass on to us consumers to here. So any type of unsecured debt, credit card debt, if you have a home equity loan that's not fixed, it's going to be going up as well too. Conversely, savings accounts, CD rates, and things of that nature will also start going up as well. So the Fed has said they need to raise the rates partly to tame inflation. The first one that they just did was just a shot across the bow. It had nothing to do with tame inflation, not even close. So the markets are kind of anxiously awaiting the next one in about a month or so when they could do 50 basis points or more in terms of a rate. Inflation, obviously, it's out of control. Gas, food, housing, all that stuff, completely variable, going up, 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 up. Hopefully, it could stabilize. It may come down soon, but we're probably never going to see the rates for quite some time that we were seeing a year or so ago. Putin invaded Ukraine, obviously all over the news on that one. So we had a lot of uncertainty. Markets hate uncertainty. So we had a lot of uncertainty in the first quarter, which drove the markets down off of the highs coming off of last year. This is normal. So we got a couple of bad omens starting out the second quarter. First and foremost, the second quarter of the second year of a presidential cycle usually tends to be flat or down. It's just completely normal as we are on the cycle. So I don't think anybody has very high expectations for the quarter that we have coming up here. We also had what we call the death cross, and that's when the 50-day moving average falls below the 200-day moving average on the S&P 500, and they call it the death cross because the markets are supposed to start plummeting. Coincidentally, after it happened, the market went straight up. So you can't always believe the folklore of the markets, but we did see the death cross happen right at month end, which we always know at quarter end. The markets usually artificially inflate because, big surprise, most Wall Street bonuses are based off of the quarterly averages. So we'll see with that. So we saw the death cross. We saw an inverted yield curve. And what that means is the interest rate, the 2-year interest rate is now paying more, or 2-year bond from the government is now paying more than the 10-year. Normally, the longer you tie up your money, the more interest you're going to get for the more risk that you're assuming, as well as not having access to that cash for a longer time. So normally the 10-year pays this, the 2-year pays this. Right now, the 2 years paying this, the 10 years paying that. So we have an inverted yield curve. Normally, that's the prediction of a recession. Now, not to scare anybody, you never know you're in a recession until you look backwards, because we have to have 2 quarters in a row to call a recession. We may or may not be in one. Inflation obviously causing a big issue with that as well too. Whether we know or not, it's usually when we're out of the recession and then they go, hey, look, we were in a recession back then. So I expect more volatility in the second quarter. I don't expect markets to go straight up. I expect it to be a very choppy ride, which is very, very normal, again, in that second year of the presidency. So what are we doing about it? First and foremost, we want you to diversify your assets. One, as an ERISA fiduciary, we have to offer you diversification. Two, we want to, try to put money in different sleeves of the economy. We don't know what's going to be the big winner going into the second quarter, third quarter, fourth quarter, the next 5 years, or anything of that nature. Nobody knows. If they tell you they do, they're lying, or they're just trying to swindle you out of some money. So we want to diversify those assets. Our strategic models are always fully invested. Our semi-tactical models in late January went to half cash. So a traditional split for a moderate portfolio is 60% in stocks, 40% in bonds. Our strategic portfolios are rebalancing today back to that 60-40 split. However, our semi-tactical portfolios, they're going to be using the exact same asset allocations, but different percentages. Instead of 60-40, we have 30% in stocks, 40% in bonds, and 30% in cash. So all of the semi-tactical models went to half cash late January as the volatility was increasing. And we wanted to kind of lock in some of those profits and try to smooth out some of that volatility by keeping money in cash. So if you're a little bit more conservative or so, it's been working out pretty well for us. If you want to stay fully invested, fully well known you're a long-term investor, then the strategic portfolios do not move to cash. What else? Oh, today the rebalance instructions went out with very specific investment options, how to diversify. To get the actual recommendations for your specific plan, your employer chooses all the investment options that we could advise you on. And then we tell you, hey, if you want to be moderate, this is how you do it. Buy 10% of this fund, 20% of that, so on and so forth. That comes through the dashboard. So you should have received at 9 a.m. Eastern time an email from us, as well as a push notification if you're using our app. This is the dashboard. It could look different, obviously, based off of your advisor. It could have different color schemes and all that. You probably, I'm assuming, don't have Albert Einstein as the picture there, but the new recommendations have gone out to you. So please go ahead and double check your account and make those changes. It's very, very important, especially with the increased volatility, to stay on top of any of the changes that you may be making. So log in to your system and look at that when you can. If you don't remember your username or password, your username is your email address, your password is whatever you changed it to. We can always reset that for you. Contact your advisor or contact us direct here at Plan Confidence. Now, with the rebalance instructions that went out today for the semi-tactical as well as the strategic models, I just want to let you know some material changes that have taken place since the last quarter when they went out on January 2nd. The income conservative moderate models, we added commodities as a diversifier, very small percentages in commodities, which have been going up dramatically with inflation. We fully expect that to continue. Also, all models except for the 100% equity model, we've added TIPS, or Treasury Inflated Protected Securities. It's a bond that actually benefits from a rising in interest rate versus most bonds get harmed by rising interest rates. So we added that to everything except for, obviously, if you're 100% stocks. We eliminated all the assets in foreign large growth, which were then moved to foreign large blend. So we're taking some of the risk off the table, saying, look, we might not have growth anymore. Let's kind of shift back a direction in terms of the foreign assets that we're investing in. We also reduced the intermediate government bonds, and we added that to the TIPS and the long-term bond category. Again, this would all be specific to your accounts in there. We eliminated the world allocation bonds. We also trimmed amounts that were in the S&P 500, the tech, and large value, and all of those, as we trimmed, got moved to large blend. So if you're a big nerd like me, you know what that means. If not, don't worry about it. Just log in, make the changes. But please know that we're rediversifying. We're getting a little more conservative, playing a little more defense than we were back in January. Let's see. I just got written down, talked the exact amounts. Again, go to that participant dashboard. If you do have any questions, I'm not sure if you know this in your participant dashboard. Let's turn that back down. Okay, screen 2. If you have any specific questions in regards to it, contact your advisor. We always put their contact information in here. Or if you're directly in the app itself, you can literally just push the button up there that says, please have Albert, Sally, Steve, whatever your advisor's name is, Kevin, have them contact me. They're then going to get an email from us letting them know that you're in your Plan Confidence dashboard and you have questions. So they should be reaching out to you shortly thereafter. So if you do have any of those questions, please reach out to your advisor directly and get the answers to your questions. Other than that, I do want to thank you for choosing Plan Confidence to give you confidence in your plans. If you have any questions, please contact your advisor. So with that, I'm going to say again, thank you. Please let your friend, family, and coworkers know about Plan Confidence, and that they too can have confidence in their plans. I hope you have an amazing April, and until we touch base again in May, I hope that you stay positive, test negative. Peace.